What's your opinion, and what do you think the Fed's actually going to do?
Yeah, so good morning. Good to see you. Look, I've been doing this for a long time, and I don't really recall a time, at least any time recently, where there's been such a dispersion of views, particularly, a day before the FOMC meeting. So our view is that the Fed will raise rates tomorrow, 25 basis points. I mean, it's going to be a close one. And what I would say is, this is this classic idiom, right, of what the Fed will do versus what they should do. I think the Fed will raise rates 25 basis points tomorrow. I do not believe that they should raise rates 25 basis points tomorrow. But again, our view has that's been our view. I mean, right. I think the Fed was fighting yesterday's war on inflation. So we never really believed in the idea of having to get this aggressive, particularly toward the end of this hiking cycle. But it's pretty clear now, with the market priced, as you said, about 75% chance of the Fed going tomorrow, that the Fed is going to deliver. I think if they don't deliver, particularly on the back of market pricing in, virtually a 25 basis point hike for tomorrow, I think it would just lend itself to confusion, worry. What do they know that we don't? So I think at this point, it looks like they're going to go.
On the first two, I think we have plenty of it already. There's lots of confusion and worry already.
Yeah.
So just to be clear, we're going to show the graphic one more time. You're actually agreeing with JP Morgan, Citi, Morgan Stanley, Bank of America, that there will be a 25 basis point hike tomorrow.
Well, either that or they agree with me.
There you go. You know what? There you go. Depends which way you look at it. Yeah. I want to bounce one other thing from your colleagues at JP Morgan. They're suggesting the Fed's already on a path to no return from a note. Quote, here's what they're saying. The Fed is facing a difficult task on Wednesday, but it is likely already past the point of no return. A soft landing now looks unlikely with the airplane in a tailspin, in parentheses, lack of market confidence, and engines about to turn off, in parentheses, bank lending. So a lot there, a lot of metaphor there, a lot of metaphor. But I think you get the point. I think the audience gets the point as well. What's your take on that?
Yeah, look, I think that, one of the things that we find really compelling about what's happening now is if you look at lending standards are rising. They were already on the rise. In fact, if you look at sort of like a four-quarter delta, right, a four-quarter change, it was like one of the biggest changes, four-quarter changes that we've seen since the GFC. Now, in fairness, it was coming from a much lower level. But again, the sort of the travel, the direction of travel, I thought was really compelling. That was before the bank sort of crisis really came into play. So what do you think is going to happen to lending standards going forward? I mean, it's just going to get even more tight. Yes. That's been a really prime source of momentum from a consumption perspective. So we think by the second half of the year, the consumer is going to look in pretty rough shape, which is sort of, again, I don't know if it's an irony or not, but if you look at where we are right now from a consumption perspective, Q1 growth is going to actually look pretty good. I mean, actually, it might even be pretty strong. But I think that's going to turn pretty abruptly on the back of a lot of this.
All right, so the Fed says it's going to be data dependent. So a lot of people, including you, believe we're going to see that 25 basis point hike tomorrow. Yep. But there's going to be a lot of ears on that commentary, as there always is, about what they're going to do going forward. What are you expecting going forward, and how heavily will this banking crisis weigh on the decision going forward? I
think this is such an important question. And I think, look, they have to, clearly they're going to acknowledge what's happening, right? I mean, I don't know how you can't. But I think the Fed wants maximum flexibility. I mean, at least if I was there, I would want to try to build a case for maximum flexibility. In other words, hey, look, if things really deteriorate from here, then clearly the hiking cycle's over. But if we get out of this, and, it's sort of we're looking okay, and inflation is still remaining elevated, then, we wanted the ability to continue to sort of hike. I mean, I think they should be aiming for maximum flexibility.
Which is over clarity? I mean, wouldn't the markets appreciate some clarity?
I think it's, but again, to our original discussion point, where's the clarity? I mean, you have half the community, half the forecasting community saying they're going to go tomorrow and half saying they're not. So I think we're just in one of those sort of fuzzy places, which is why I think maximum flexibility is exactly what the Fed should be aiming for.
Do you think the market would respond well to them saying that's it?
I think that the market might worry about that. If that is it, then why is that it? Is it because all of a sudden, hey, things really are deteriorating much more than we even think? That's why I think I think if we're being honest, I think that the Fed has had a hard time with narratives, particularly over the last year or so. I think it's going to be a really tricky one for the Fed to pull off tomorrow.